Within the third subsection of this chapter, we will be reviewing different types of trading styles and the advantages and disadvantages between them. I have defined a trading style as a systematic approach to trading in regards to the decisions that you will be making when buying and selling instruments. The trading styles I will review will be distinguished through characteristics such as trading duration, frequency of trades, and the underlying principles that are driving this decision-making. I have categorized this section into 6 unique trading styles, including day trading, swing trading, position trading, high-frequency trading, algorithmic trading, and contrarian trading. If you do not care for a certain style or approach, feel free to skip through, as I have separated each style into its own lesson. That being said, let's begin with day trading. Day trading refers to the action of buying and selling assets within the same day to capitalize on short-term fluctuations in price action for short-term profit. Now, this is probably the most vague definition that I will be providing, as day trading is often coined for the general buying and selling of assets within a relatively short period of time. You can imagine day trading as the more elongated label of trading, but still, let's look into some characteristics of the technical style of day trading. One common characteristic is how price moves, which are typically due to inefficiencies in the supply and demand of the underlying asset. In other words, a day trader by definition is taking advantage of markets where buyers are more aggressive or sellers are more aggressive. These variances in aggression can be due to a plethora of factors, including but not limited to news and product releases, rumors, market sentiment, technical analysis, and variance in trading volume. A typical trade under this system may last from a few minutes to a few hours, but is to be closed before the exchange closes on a given day. With that said, let's get into some advantages of day trading. Since positions are typically closed before the market closes, profits are realized immediately, which helps the trader maximize their capital. When you are in an active position, the capital or money that is involved within that position cannot be used in other ways. So, that capital is essentially useless to you aside from the open position that you were in. Therefore, many traders believe it is best to enter and exit positions as quickly as possible, such as within a day, in order to use their capital to the best they can. Not only does this allow the trader to make the most of their capital, the trader will not suffer from potential fluctuations in price action overnight, which can often result in drastic changes from events that occur outside of the typical trading hours from 6:30 a.m. to 1 p.m. Pacific Standard Time. Remember, the market is closed a majority of the day, meaning when important news or events are released, it is more likely to be released outside of market hours. Unfortunately, there is a lot more manipulation that occurs outside of the typical trading hours, which is why such massive moves may occur, but we will not be going over that within this chapter. Another benefit to day trading is the flexibility that comes with day trading. Since the trader opens and closes their positions so frequently, they are able to analyze their trades on a constant basis and change their trading parameters or strategies instantaneously. This can lead to very quick adaptations and improvements among one's personal strategy and is simply more effective. Someone who is taking, say, 1 trade per month instead of 1 trade per day probably has less information to work with in order to tweak and improve on their strategy. All that said, information can only help you so much to make more money. What is even better than that is to actually make money, which leads me to one major disadvantage to day trading. Since day trading typically involves quick trades, there is only so much potential profit that can be attained. Markets do not typically make substantial moves in mere hours, but can produce massive moves throughout many weeks or months. To combat this, many day traders leverage their positions, otherwise known as trading on margin, in order to realize a fair profit. Instead of increasing position size, traders may also decide to increase their quantity of positions, thus increasing potential profits. The only problem with this is that due to decision fatigue and other irrational behavior, the trader may begin to make emotional decisions and ultimately overtrade themselves, potentially leading to greater losses than once expected. At a certain point, this can lead to the violation of the PDT rule, another negative aspect to intraday trading. As mentioned previously, a trader is labeled a pattern day trader if they open and close more than 3 intraday trades within a given week. If the trader goes past this amount of trades within a given week, they are restricted from opening new positions for the remaining week. And once again, this rule only qualifies for trading portfolios below $25,000, so any portfolio valued at or above $25,000 does not have to worry about this rule. Overall, day trading can be very advantageous to the trader for a number of reasons, including the maximization of trading capital, reduced position risk from avoiding overnight movements, and high turnover, which can lead to increased efficiency in strategy adaptation and system optimization. Still, there are some disadvantages to consider, including the limited profit potential within a given day, the increased risk in overtrading and making emotional decisions, and of course, the violation of the PDT rule, potentially limiting the number of trades that you may want to take.